All right, welcome everybody. We appreciate people attending today and those checking out the recording. With us today, we have Corinn from Hearthfire Holdings that's going to talk about how to deliver value in self-storage for us. Corinn, thank you for coming on and supporting the left field community. We appreciate that.
Thank you so much, Chad, for having me here today. Really looking forward to really simply walk through this talk here today and kind of take a different approach. I'm not going to talk about why self-storage is such a great asset. There's plenty of those conversations out there, but really share our direct experience since we entered storage with our first acquisition back in 19 and bring some of that theory and some of those headlines into actual, what does it look like? What has it looked like in our life and in our company's growth? So
that's great.
Thanks for having me.
No, absolutely. No, we look forward to the conversation. I will say before I turn you totally loose to the group, anybody that has questions, please feel free to dump those in the Q&A and we'll make sure Corinn can go through those as well. But after that, or beyond that, I should say, I'll turn it over to you. Thanks again for coming on.
Thank you. Thank you. And yes, I do encourage everyone to make use of the Q&A or the chat. My agenda today is very simple. I'm going to go through 3 case studies. I think I have about total 13 slides. So there's I wanted to allow plenty of opportunity for this to feel a little bit more like a conversation. As I go through the case studies, if that sparks any questions or if you want to go deeper in any way or any parts of those projects, I absolutely will. So without further ado, I'll start diving in. And as I do, You'll no doubt pick up on some of the common themes as we've standardized upon approaches, our operations, our tech stack. It's been quite the journey, really, these past few years. All in, Hearthfire Holdings started in September. It will be 11 years ago. We started in multifamily, and it was started by myself and my now husband and partner in all things, Sergio Altomare. We met, and our early courtship days were when I was hunting my first multifamily investment property. I first came to real estate as a way to build a little bit more of a passive income foundation for myself individually. My previous career was in the arts. And so real estate for me was really initially just a tool for me to be able to spend more time pursuing my passions without them having to pay the bills, because it so rarely does in the artistic communities. So very quickly backtracking, 2012, I bought my first multifamily. Shortly after that, we began buying properties with family and friends, our small multifamilies in and around Philadelphia. So these are essentially kind of small multifamilies that were maybe large homes that had been converted into multifamily over the years and the generations. We were both working full-time for the Federal Reserve Bank of Philadelphia. For myself, Philadelphia. Sergio worked for the national IT organization serving the Federal Reserve. So this all started as a side hustle. And in 2017, I quit to focus fully on the firm and our growing portfolio. We had about 150 doors at that time, give or take. And then the following year, Sergio quit as well. And we positioned all of our multifamily for a sale. We were looking back to 2008, and we're looking for something a little bit more recession resilient because we were expecting a market downturn somewhere in the 2018 to 2020 timeframe, roughly. So we positioned all the multifamilies to sell, and we redeployed that capital into our first storage acquisition in 2019. So we are still relatively new in the storage space, and we've been filling in that gap of experience with the team that we've been hiring and growing and building around us. And I'll touch upon that at various points as we talk, because people is so important, right? At this scale, commercial real estate, it's all about the team. It's all about the collective expertise that you assemble, because at this level, no one person can do all the things. So it brings us to today. 2020 was a gap year, I'll call it. 2021, we acquired 10 more facilities. 22, we acquired 4 more facilities. This year, so far, we're under PSA on 4. We have multiple LOI negotiations going on. So we'll see where we end up for the end of this year. Anyway, that's my super quick backstory. Let's dive into the case studies. That's way more important and entertaining. So case study number 1, this is our very first storage acquisition from August of 19. Our investment thesis here was simply to get in the asset class with a project that really required minimal CapEx improvements. That wasn't our expertise. Both of us worked in technology for the Fed. So we were looking for a project where we could really bring our tech expertise and backgrounds to bear. And we found that in this one. It was operated by a husband, wife, all paper and pen, really no technology systems or back end. So here it was tech first, tech implementation project all the way. Our acquisition strategy, we did go through a broker. This was an on-market listing. As a husband-wife team ourselves, we were able to connect with the sellers on the intricacies of working with your spouse and being responsible for the family fortune, if you will, because at this time, all of our investors were family with a couple incredibly close friends. So we were able to win out in a very competitive kind of bidding nature here by differentiating ourselves from some of the other potential buyers and really on a person-to-person basis, just showing up as who we are and having those down to earth and grounded communications with the sellers, which ultimately made for a really seamless transition. Thank goodness. Good relations with the seller for any questions that we had post closing as we were kind of diving into all the day-to-day operations. I should mention that we did all of the day-to-day operations ourselves at first. I would say the first 3 to 6 months. We initially were doing the drive from home, and this was close to home, but enough of a commute where we ended up buying a travel trailer, set it up on site as kind of our crash pad apartment, if you will, and split the weeks. Our daughter was 2 at that point in time, so we were juggling our couple of our other things going on, as well as her, as well as learning storage and operating this facility and implementing our business plan. So tons of lessons learned here. We knew that long-term, we did not want to be the ones managing all the sites. We knew that we wanted to grow a storage business and continue to find more opportunities to deliver investments for our investor friends and family and community. But we spent enough time in the weeds, in the day-to-day operations to first and foremost, have deep appreciation for the people that we ended up hiring to step into those roles, and then be able to build our team as we continued to scale. So I think here, really what I wanted to highlight was, very simple process of going from paper and pen, literally, and cash to basic technology systems. So we implemented back-end a facility management platform. When we started out, that was SiteLink, which is absolutely a monster in the industry. They've quite the corner on the market. We most recently switched over to Storage, which is another huge player in this space. Either of those both deliver the opportunity to really just streamline the operations. You can build out all kinds of rate management rules in the system so that when you achieve certain barriers of, say, you're at 90% occupancy, or you have all of your 10 by 20s rented except for one, well, that last one, the price is automatically adjusted up 15, 20, 25%, however you set up the rules, and building in those kinds of automations so that whoever your manager is on site, they don't have to be remembering to do that. The systems are there now. You just set up the rules once when you're doing your tech build out, and then let that run during the day-to-day management. From the front-facing customer experience, this brought an entirely new and different experience that we all became very used to during COVID, right? Contactless, self-serve, auto pay, really the customer experience showing up where they are. As long as they have a smartphone, you can access our mobile enabled websites. You can find any available storage units, kind of filter based on what size, how much you have to store, select that. You get sent electronic documents for review and signature, electronic payments, and then you get your code to access the facility, to go through the gate, follow the map to find your unit, and you are all set to move in. So really all of that tech backend and operations we implemented within the first few months, so that when COVID hit March of 20, we were able to shift to completely contactless remote management without skipping a beat, because we had all that tech backend already up and running. So that we have continued to implement as we've grown. So on the tech front, I won't say all the same stuff for the next few case studies, because it has been the same ever since for each of them. Maybe a few tweaks if it's the specific back-end management software, if it's moving from SiteLink to storage, but the functionality and the same kind of tech back-end has remained the same as we've grown and scaled our portfolio. So the outcome here from all of that, and there was minimal CapEx on these projects. We upgraded some of the parking. We created a few more parking spaces. We did convert some of the units from standard to climate control. That all helped drive a little bit more NOI. We ended up selling this one 2 years early than our projected business plan, because we increased NOI 38%. When we decided to position it for sale, the market was on probably the highest that it had been. It was right at the peak. And so when we ran the numbers, we would have not been serving our investors if we had not sold. So we went forward with that, delivered over 30% IRR, a little bit over 2x equity multiple. And through a 1031 exchange, we're able to redeploy that into an acquisition of 2 new locations, both of these in new states. So this is, now that we're 4 years later in our journey, where when we began, we wanted to start just in our backyard, somewhere where we could go and walk the property or deal with any emergencies and be on site and in person almost immediately. We now, 4 years later, as we've grown and scaled, I can't just buy everything in my backyard. So we've expanded out into other states. One of these locations is in a market I'll talk about a little bit more in case study number 2. And I added some nice little animation here for you all. So we are turning those acquisitions into, as you can see here, some renderings from the architects. Both of those acquisitions are more than doubling the existing square footage. The markets show demand for it. So this is another kind of later stage. If I were doing maybe 4 case studies, I would talk a little bit more about these. But in the interest of time, and I think we'll hit enough of the story arc today. So that's kind of what we were able to turn that first one of, just our first 15 investors, a small site, all things considered, 22,000 net rentable square feet, into these projects that we're embarking upon today. So that is case study number 1. If there's not any specific Q&A on that one, I will move into case study number 2. Okay. So here, this portfolio was a big step for us for a number of reasons. First, we went out of state. Secondly, this went from acquiring a single facility, and there were other acquisitions between case study 1 and 2. So I don't want to falsely represent that we went from 1 to buying 5 out of state. There were a couple more in state in our backyard that we added to our Pennsylvania portfolio. But this was an acquisition of 5 total sites. And in the state of Indiana, it was a little bit of a mix of on-market or pocket listings through our broker relationships, as well as when Sergio flew out there to do due diligence and met the seller. The seller mentioned that he had another kind of annex location, if you will, that wasn't listed, but upon meeting and touring and getting to know Serge, decided to add that into the acquisition. So again, you know, so much of business comes down to the human element and relationships and solving problems for one another, and really at the end of the day, being able to meet everyone's needs in the most beneficial manner. So I think just the humanity aspect of it and the creativity that we try to bring to looking at every project really has helped us continue to grow and evolve from our initial acquisition to where we are now, just 4 short years later. So out of state, a little bit larger portfolio presence, kind of a variety of sites in one general area, but a little bit more dispersed across secondary, tertiary markets in very northern Indiana. We also went third-party management here. We didn't feel completely confident in managing from afar across state lines. So we brought in third-party management here. We also built our team and had additional folks who were doing deal sourcing, underwriting, as well as fundraising. This was a bit of a step going from our first 15 investors to approximately 50 on this one. So it wasn't, you know, that was a decent enough kind of jump. So we brought in additional folks to help us bear the load across those multiple work divisions, if you will. And here the investment thesis was, you know, acquire these multiple small facilities. They were all operating under different individual brands. What we do is everything is brought into our brand. Everything is operated the same. So we're bringing a consistent customer experience to market. We're also able, by entering and really dominating a market, able to refer clients. If somebody calls in at one facility where we're full, or maybe I don't have exactly what they're looking for, we can, or not me, but our call center associates can reply to the customer, well, you know, we don't have that exactly, but we do have a sister site that's 1 mile down the road, and I'm seeing that they do have something like this. We're also able to offer a little bit of the good, better, best pricing model. So depending on the customer calling in, maybe they don't want to pay top of market rate for a climate control unit, but I can offer that same size for a discounted rate in a non-climate facility, maybe not at the original location, but close enough where it's drivable still for them and makes sense. So there's a number of benefits to and reasons for why anytime we enter a new market, we are looking to come in with more than one acquisition. Some of the other, the tech backend here was all really the same as the first, getting our management software to speak with our gate technology so that anytime somebody, you know, runs late, their gate code is automatically shut off so they cannot access the facility until they're paid up in full. All of those kinds of tech enabled basics. Here we also, there really wasn't much tenant protection. So in storage, another ancillary income stream, if you will, is offering your customers tenant insurance or tenant protection. We took the approach here of auto enrolling all of our customers, which took us from, you know, 0 or single digits penetration rate to 75% penetration rate across our customer portfolio there. At a couple dollars per unit per month, those kinds of small incremental different income streams all certainly roll up and ultimately drive really better bottom line to our investors. We also, on the expense side of things, were able to drop the expense ratio 10% and modest rent per square foot increases of about $2 per square foot. Now we're about, looking at my calendar, about 1.5 years into this project now, so there's still room to go. But at most of these sites, there are some sort of expansion or conversion component. Some of these where you see a freestanding building at the front, those are maybe offices that we're converting into additional storage, because in our kind of hub and spoke, largely unmanned model, we really don't have a need for large offices. In the hub and spoke model, generally one site in a region is perhaps the home office, and then otherwise our manager floats between the sites or only goes to visit the sites for safety maintenance checks, walkthroughs, or to meet customers that specifically request an attended tour. So that's also some ways that we're able to cut our expenses by taking this kind of portfolio approach, because each of these sites had at least a part-time manager on them. So by taking our kind of consolidated approach, we have one manager now who's floating across all 5. Same in our Pennsylvania portfolio. We have 5 total properties in Pennsylvania. 4 of them had 3 different managers all total when they were run by when they were run by the sellers before we bought. We now have one manager who manages all of them in this kind of hub and spoke model, with all of technology up and running and allowing our customers to really self-serve, transact, and automating as much of that tenant life cycle as possible. So all in, with case study 2, so far, we've increased NOI 34%. These are 5 to 7 year hold projects as well. We still have really decent amount of runway to go with these, getting the expansions and the conversions up and out of the ground, bringing that to the market and getting them a little bit leased up. They're not huge expansions. The next case study is, and that's a whole other animal and investment thesis, but these are kind of just small little projects at each site, and so we're excited to see where that goes. I think I jumped ahead of myself a little bit here and talked about some of our next expansions being much larger. So I mentioned in case study number 1, the 1031 exchange into 2 properties. So one is in the same immediate market as case study number 2, northern suburban Indiana, right along Lake Michigan, the furthest edge of Chicagoland MSA. So here we added to our geographic presence by acquiring a truly mini storage facilities, just these 2 drive-up buildings, a total of only 66 units. But it came with additional acreage where we are building a multi-story climate control building, as well as adding some more drive-up units and parking. Now, of course, anytime you're talking about large expansions or developments, you want to look at your supply demand. So we absolutely dug into the details to really triple validate that we were bringing to the market what we thought that it was demanding, and validated that before moving forward. We have, so we're really excited about this expansion that is expanding on multiple levels here. So we're not only expanding the individual lot, the original mini storage, as well as the additional acreage. We're expanding our presence as an operator in that market, adding new products, so bringing the climate control storage. We had no climate control in case study number 2, so we're bringing a new, different type of product to the market for our storage customers. And we're made sure to confirm through our feasibility studies that there was still strong demand. We're seeing a lot of multifamily as well as industrial developments going in this area. So future projections as well are strong. And then the other element of expansion here is bringing to our investor base different types of project profiles, right? Value add from case study number 1 being a really simple, just upgrade the business operations, improve some of the tech so that we can drive value really purely just on the business side of things, less to do with the actual real estate asset or any other large CapEx there, to now doing some more smaller expansions, conversions, larger expansions, and our next step future look is to doing full ground up developments. So that's case study number 2. Let's dive ahead into case study number 3. The biggest growth here. So this is another out of state. This is in Illinois, but it's 40 minutes from our Indiana portfolio. So still folds nicely into that area. We were for a while having the one Indiana manager also manage this one. Now, as we get to groundbreaking and lease up on this expansion, given the size of this expansion, we will have a dedicated resource here full-time. We have someone here part-time now. As the buildings get out of the ground and we get more heavy into the lease up process, they'll be there really full-time so we can accelerate that. So some big steps here. This was our first 506C opportunity. So historically, we have done all of our investments as a 506B for sophisticated investors that we have relationships with. This was our first stepping out into 506C land for accredited investors only. We also added third-party construction firm here, given the scope and scale of this project. So that's the additions on the people front. On the process front, we are expanding our investment thesis and parameters here, right? From value add to maybe value add plus some small expansions, very large expansion here, right? And this one also was, I believe, an on-market listing. We incorporated all the back-end operations and tech into our Indiana portfolio, all the same kind of systems and processes there. And so far, I mean, the biggest thing here obviously is getting the building out of the ground. So far on the business side, we went from 0 or single digits insurance enrollment to 60% insurance enrollment. Delinquency here was 14% when we acquired it. We've been able to bring that down to 2% by implementing a regular auction process, using automation tools to text, call, email, remind customers that they're going through the auction process. All of our auctions, again, are all online. This is not a reality TV show, auction wars kind of setup. We do all the listings online for remote virtual bidding, and then whoever wins on the online auction is the one who shows up at the site and cleans out the unit for us. Here we are expected, we're breaking ground next month, and then we expect our CO and to start leasing units by late Q2, early Q3, or am I getting, late Q3, early Q4 of this year, 15 months post acquisition. So this one was a big expansion for us, a big step forward as we refined and evolved and kind of grew our team, our targets, all of those things. We're very excited to see the building come out of the ground in a couple of weeks here. One final point I wanted to share on construction management overall. When we broke ground here at this Illinois location, we also introduced to our investors a whole other level of transparency. We have cameras set up on the front of the facility, the front of the existing facility, that are facing the raw land that will house the new storage units. And our investors have logins to that video so that they can access the project 24/7. We just love that really fosters the relationship with our investors, that they're truly partners with us. So we're, giving them complete access to what we are seeing from our side of things. From a management perspective, it allows us to keep a close eye on the project without the cost and the time to physically fly someone from our maybe corporate or executive team out there. And we'll be continuing to do this for all of our ground up development projects going forward. Funny story on this one, I had an investor log in last week and sent me a note saying, "Hey, I haven't seen any activity for the past 2 weeks. What's going on?" which I loved, right? Like this tells me that our investors are taking advantage of what they're offering to them and that they're not shy about reaching out to us, right? And it also allowed me the opportunity to say, thank you for using what we're rolling out for you as well as our team. And we learned that there was so much groundwork that's required in the rear of the property. We didn't think to put cameras back there to give you kind of a full scope perspective of all the almost pre-work, right? Expanding the retention basin. There was just a lot of groundwork and excavating being done on the rear of the property. We don't have cameras set up back there, but that's where all the guys have been working for the past few weeks. So lesson learned, we'll figure out perhaps more expansive angles at future build sites, or we'll learn from that and continue to iterate and improve as we go forward. But I just love getting that call, because that means that the investors are taking part and do feel like they're really on this journey every day with us. So that's my final note on construction management. And then a super quick peek into what's coming next in our acquisitions pipeline. We have projects currently under various stages of PSA and LOI, so I don't want to get too far ahead of myself here. I will simply say that we're continuing to broaden our investment parameters. I think hopefully you've gleaned from this conversation that our journey has been one of just continuous evolution and growth, and continuing to add more opportunities to how we're looking at investments and other profiles of projects that we can bring as we grow and evolve and scale this program. So right now, we're seeing better yield on ground up development projects. So we do have some of those profiles that will be coming in the pipeline to our investor community, and we'll continue to also add value add as well as kind of core existing facilities as we look for balance across all those different buckets. Each of those are slightly different investment profiles from their return projections, from the length of their hold time, and risk tolerances. So that's just a super quick peek into what we're thinking about the future in these very interesting markets and times that we are in. And also to future strategy, ultimately our end goal thinking is to position for a portfolio sale to an institution or a larger operator. And so we're continuing to see appetite and investment demand for self-storage in general as an asset class. We're seeing a lot of flight to safety, if you will, of maybe investors who have been primarily certainly in the commercial office sector, wanting to flee to storage and seeing it as a more safer investment opportunity now in these very embroiled markets. I did want to share on the screen two headlines that we found particularly relevant. One is from September of 22, so it's a little bit older at this point. But this was Extra Space acquiring a large property portfolio within the Indiana, Illinois, Ohio, Kentucky, I want to say, locations. Why this was a headline is because this indicated the first time that a REIT had gone further afield from their primary downtown urban markets into secondary and tertiary markets, and also acquiring a portfolio that was unmanned. So this showed us that REITs are starting to have to go a little bit further from their original strict investment criteria, where they're largely in primary markets, fully manned facilities. They're expanding that, right? They're looking for more yield and returns for their shareholders. So this headline was the first evidence of that. We were also particularly pleased to see that happening in places like Indiana, where we are building a presence. And then most recently, this was just a few weeks ago now, Extra Space acquired Life Storage. And this is after Public Storage made multiple hostile bids to take over Life Storage. So Extra finally won out the day on that one. What this did was consolidate the top 6 REITs, Public, Extra, Cube, U-Haul, NSA, and Life now into 5. So we're continuing to see on the very highest level at the industry, appetite for mergers, acquisitions, tons of large sources of capital that are coming into the space. And so that supports our end goal as far as what we're building for an eventual sale as we execute upon these business plans. And that is all that I brought to speak at you today. I hope there's some Q&A and that we can make this a little bit more collaborative, Chad.
Absolutely. No, thank you for sharing that. A lot of growth going on in your guys' world, that's for sure. Seems like you guys are really clicking along, which is great to see. So we appreciate the info share and teaching people a little bit more about how you guys approach the self-storage space. But we do have a few questions. The first couple kind of marry together that I'll blend them together, but it was around what your typical buying criteria is, or even the first question was, could you share your top 5 metrics that you look for when you're purchasing? What's your approach to that buying side thing of the process?
Absolutely. And I can't take any credit for this myself. Our director of acquisitions is a rock star and has come in and led this space. So his name is Henry Metcalf. Let me give him proper shout outs. He joined us from, he was previously with Lightbox Storage Partners. He was previously with Extra. And before that, he led land sourcing and underwriting for the largest home builder in Utah. He lives in Salt Lake City, Ivory Homes. So he's got deep experience in underwriting land, existing facilities, and bringing a really, really strong acquisitions pipeline. So top criteria that we look at are first and foremost saturation, right? We don't want to go into, especially if it's a development project, we don't want to go into or possibly cause a market to become overly saturated. So we look, best possible metric would be under 6 square feet per person within the 3 mile. Now we will buy something if it's slightly higher than that, if it's in a 5 or 10 mile, but I'll give you our absolute best criteria that we look for would be in the 3 mile, sub 4 square feet per person. We look for strong population. So we look for 30,000 population minimum. We look at rent rates and median household income and what an average 2-bedroom apartment goes for, because we don't want to be in any, I'll say, distressed or possibly stressed markets. So we look at the migration patterns, we look at our population of people, and we look at what those people are paying for their homes, whether they own or buy, to make sure that the overall climate of the area is solid, positive, ideally on an upward positive trend. So those are, and then we do look for renter occupancy percentage, because there's stronger utilization of storage where there's a strong tenant renter base. So those are some of the key criteria that we look at. Pause there, Chad.
Yeah, no, that's great.
Questions?
Yep.
Okay.
Well, there was that kind of follows up to that of asking about when do you decide on climate control? I don't know if that's a certain percentage of the property or based on location more, or how do you guys kind of go through that process of deciding on climate control?
That one's, there's a little bit more art in that one. Again, this is me conveying from what I have learned from my team, right? So we look at if the other operators in the market, if there is climate control, we will either speak with them directly or do a little bit of secret shopping to try to see on the climate control that they have, well, on any of their occupancy, where their occupancy is, right? Are they completely full? Are they only half rented on their climate? Is that because it's completely new and they're in the middle of a lease up, or has that 50% been sitting there vacant for a while? So all kind of an artistic discovery process. Mm-hmm. If there's absolutely zero climate in the market, then we look a little bit more closely at the demographics of the area to determine if that higher quality product because you generally charge, I'm forgetting what the rent premium is. It might be a 20% premium that you charge for climate if that market really will bear it. So that's more diving into the specifics of that local community. And again, storage is such a micro market business, right? We're looking at the 1, 3, and 5 mile radius. Some of our more rural areas, we might stretch out to 10 if it's a very rural area. So I don't have a complete verbatim quote that I can give you as far as how we determine climate, but that's a little bit of some of the analysis that goes into it.
Yeah. Okay. No, perfect. Next question was, how much weight do you put in the index population per square foot? Then under 7 was his question, I guess, but how much weight it goes into that index population per square foot?
I would probably be giving away some of Henry's secret sauce. I know that he does have a weighting criteria. I don't have it off the top of my head, but I know that because he stepped us through all of it, that we do have a weighting criteria on each of those categories. If you'd like to reach out to me and we can take that answer offline, I'll see what he's willing to share. If I can share it with you, I will.
Sure. Yeah. No, that's fine.
Yeah.
Next question was related to loan and asking what kind of loan products are available for storage. What does that, can you speak to that? What you usually find there? Yeah.
So I won't spend too much time talking about what we used to get, right? Because those days have come and gone.
True.
We are, I will say that we are sleeping perfectly fine at night because all of our current in-place debt are fixed terms until early to mid 26, I believe, is when our first couple ones come due. And those will be on projects that should be done by that point, right? So, so that's history. We also have all of our loans are personal recourse. We don't have any non-recourse loans yet. So Sergio and I are personally signing and guaranteeing on all the loans. They do all support themselves. There's nothing cross-collateralized. Some of these portfolios, the case study number 2 with the portfolio of 5, those properties are all, supporting one another since that was a portfolio acquisition. And then as far as what we are finding now, this is where, let me give a shout out to another team member who just joined us after having probably at least a month or 2 of talks with him. Ethan Bloom joins us as our Director of Capital Markets, and he comes to us. He was previously Director of Debt and Equity at Avis & Young for 8 years, and then he was an investment associate at LFI for 6 years. So he comes from the investment financial space, and we really were targeting someone like him with deep experience in originating capital, structuring things, and lining up the financing. So again, as we've grown our team, right, like this is absolutely not just me putting everything together, but really lining up experts in each space. So this is probably a roundabout way of answering the question. So what we are finding today, what Ethan is finding today in how he's in the conversations that he's having with various debt, there's certainly banks and the lenders that we're speaking with are more comfortable offering recourse loan structures versus non-recourse. They want to see that the operator is committed and is ready to stand there as a backstop should anything, God forbid, go wrong. We are looking at higher levels of bringing equity to the table, right? So where we could have maybe been at 65 to 70, we're seeing 55 to 65% loan to value, and terms are 6.75 to 7.25. On a call, I had a call yesterday with someone, I believe they said SOFR plus 275, maybe SOFR plus 300. Hopefully that answers the crux of the question there.
No, I think it gets to an idea of what you go through.
Yeah, I mean, we don't have any corporate debt. We Sergio and I have not taken a salary yet in our 11 years with the firm. Everything that we've personally been able to generate as GPs, we have reinvested right back into the company infrastructure to pay for these experts, right? To pay for people like Ethan and Henry and our COO, Mike, who's amazing and has over 20 years experience in the industry. We were able to, he started in public, went to Extra, was with Store Space before us, just talk about experience in this space, like just being able to bring a whole other more deeply entrenched wisdom and perspective to what we're doing and how we're building our company, what kinds of properties we're targeting next as we weather these, these storms that have people, rather uncertain. Fun story. Mike has been through, I think, 3 or 4 recessions now, depending on how you define recession, in storage. And each time, the experience in storage on the operations side, because he's an ops guy through and through, was, it was barely a blip, right? The recessions were more, more maybe for the tech employment sector or maybe hitting other fields. But his biggest lessons learned were, when we went through the depths of the recession and everybody was scared and pulling back on all of the revenue management plays, all of the rent increases, or just afraid to spook the customers, we learned that we didn't have to compensate that hard, right? Like COVID was a massive boon, as terrible as it sounds to say that, for the storage industry overall, right? We're seeing, 20 to 22% rate increases during COVID times. Now that's starting to taper off now. We're getting back into the, lower double digits, still double digits, but lower, because COVID was just such an interesting event for our entire world. I just went completely off topic, Chad. I'm so sorry. What was the question?
No, good knowledge. No, it was back related to the loan structures and so forth, but that's fine. You got to it. Yeah. There's a couple other questions that have come in too. The next one's related to NOI and asking, what does your strategy kind of feed that your NOI needs to get to before you look at doing refinances and returning capital to investors and so forth? What's your strategy or the business's strategy around that typically?
Yeah, so we are one of our newer projects that I am absolutely not fundraising for today. I want to make that very clear. I'm not pitching anything. One of our newer projects is one of the significant expansions that I talked about here, right? So that one is no cash flow for investors until year 4, after we've got the building built, leased up, refinanced, once, we have done all of that. So that's going to be a longer term hold, and we're going to need patient capital on that one, just because it's a different profile of project. Some of the other projects where they're smaller, simpler, more business operational improvement, or smaller expansions or conversions, those are spinning off distributions now, whether we're 6 months, 12, 18 months in, those are spinning off quarterly returns now. I don't know if that's exactly answering the question. Our target returns that we are making sure that anything that we're looking at now hits is, it has to be somewhere in the 185 to 225 equity multiple. We're looking for 8.25 to 9.25 yield on cost, 7 to 9% cash on cash, and 16 to 20% IRR at the investor level, not at the project level, right? So the project level will be more than that, but we want to make sure that our investors are seeing somewhere within those parameters for that deal to pencil for us. So hopefully that makes sense. Got to the answer.
No, I think that helps. Yeah.
Yeah.
So left fields, we're a community of limited partner investors. So they're always looking for education and understanding of process strategy from an operator standpoint to get to that know, like, and trust kind of level. So no, I think all that information is very helpful for educating our group what your philosophies are and that kind of thing. You had spoken about how you used to be 506B, you've kind of migrated to 506C. Any plans on going back to some 506B offerings, or are you strictly going the other way? Okay.
Yeah, it's not an either and either. It's a yes and. It's not an either or. It's a yes and. I just that's how we started. Those are the people that we started serving. And if we went completely 506c, then we would have to abandon some of our core, and we won't do that. So so we will continue to do 506bs. Obviously, those are only shared with our existing network. So thank you for allowing me to come in today and just share. It's, you know, it's tricky getting the word out if you're somebody who offers 506bs to get the word out. And it's something that I'm particularly passionate about, because I certainly knew nothing about real estate in my upbringing and my previous careers. And so the ability and I think responsibility to continue to share the power of these kinds of real estate investments and the impact that they can have for folks, even if you're not accredited, right? It can be life-changing, not overnight. It's a slow and steady process here. But I think what we're doing is incredibly impactful. And so we will continue to offer 506b at the scale that we're operating. We probably will do a few more C for accredited only, but we will never abandon that sophisticated investor base.
Gotcha. No, that's great, because we do have a population of non-accredited associates in our community that are always looking for new operators to get involved with and so forth. One of the other questions that did come in is, how can we get into your deal flow? They should just reach out to you with this contact information, I guess. Is that the easiest?
Yeah. Please email me or on our website. I'm sure there's an opt-in form somewhere. If it's just as easy for you to shoot me an email, tell me about yourself. We'll have a call, phone, or Zoom. I love to see faces. I can put a face to an email address and get to know one another and start building that relationship so that when the time is right, and assuming we have an investment opportunity that works for their goals, that we can work together.
That's awesome. Great.
Yeah.
We did have one other question that popped in. What are your typical buyers of these exits in the third party market? So who are you selling to usually when you finish?
So ultimately we'll be selling to institutions. The case study one that we sold to a huge private equity firm, and we're really surprised that they had any appetite for it. So that will be the end. The end goal is building these portfolios of small to mid-sized properties that individually are not big enough to interest some of these larger institutions. But the work that we're doing, the business plan, the value add play on our part, is to assemble all of these into a package that at the sum total of the parts is very, very interesting to whether it's institutions or whether it is a REIT, which is what we saw with Extra buying that portfolio of 107 remote unmanned sites across kind of Midwest. That's, ultimately that's our end game.
Gotcha. Very good.
Yeah.
Well, great. I appreciate the time today. Looks like our questions have dried up, but a lot of good questions that came through, a lot of great material to share today. So thank you again so much for joining our community and sharing some info. A lot of exciting things going on at Hearthfire. So
thank you, Chad. I hope this brought, maybe a little bit different element or approach to the self-storage topic.
Yes.
I really hope everybody found this time useful and valuable. I know time is all of our most valuable asset. So thank you for the time and the opportunity today.
No, absolutely. I think the case study model was a good model to take as a different approach from what we usually see. So thank you for that.
Awesome.
Well, great. Right. Well, thank you. Thank you to everybody that tuned in today. But we'll shut it down then.
Thank you.
Thanks, Corinn. Yep. Take care.